Before we move to capital gains, let me just pick one question. Okay, before the question, let's um, revise the provisions of PGBP very quickly. Whatever we have discussed up until now. The first concept was about depreciation. In depreciation, we had now 180 days concept, where if less than 180 days put to use, then 50% of the depreciation will be allowed during the year. We have different rates. We have 10% for building, 10% for furniture, intangible assets 25%, plant and machinery. For most of the plant and machinery, it will be 15%. For specific ones, for example, computer, books, those it will be 40%. So if the put to use is less than 180 days, again, half of these rates, for building 5%, furniture 5%, intangible assets 12.5%, computer 20%, and so on and so forth. How we calculate the depreciation is by just calculating the written down value, closing written down value. How we calculate that? We simply add the purchases to the opening value, we deduct the sales, and we calculate the closing written down value. Here, the concept of block of assets came into picture. If you remember, in the block of assets, how we used to calculate is we used to find 4 blocks in total, and those are: one is building, one is furniture, one is intangible, one is plant and machinery. Now, however, when deciding the block, we will look at first one is an asset. Two separate assets should be falling in the same block, and also they should have the same rate in order to calculate those two together, or those few together. Now, one concept of block, if you remember, the individuality of the assets goes off, the block's existence comes into prior importance. What do I mean by that is, if you remember, suppose we had two assets, 10,000, 20,000, total was 30,000. One of those machinery we sold for 35,000, then the block does not exist anymore, because you have sold for more than the value that was there for the whole block. Even if you are still using the machinery one, as per income tax, that block is not existing anymore. Now, very quickly coming to enhanced depreciation, which was 20%, only applicable for new plant and machinery purchased during the year. Only plant and machinery, not for building, not for furniture or intangible assets. Only for plant and machinery, and only in the first year of acquisition. Now, in the first year of acquisition, if the plant and machinery is put to use for less than 180 days, then this additional depreciation also becomes half, that is 10%. However, only exception here is, if you remember, here the other half will be allowed in the next year. When the normal depreciation, when we were talking about the half, the other half will not be allowed at all. The difference between this half and the half of the enhanced depreciation is, the other half of the enhanced depreciation will be allowed in the second year of the plant and machinery. Now we had another concept of how do we do the add back of expenses. I'll just remind you of one simple example where we had sales of 100 rupees, expense of 20 rupees, and our profit was becoming 80 rupees. Suppose our expense is decreasing, our profit will increase. So we have to understand, if the income tax is not allowing some expenses, that means expense has to decrease. We have to add back that portion, not decrease it. So if the expense is decreasing, our profit will increase, and the other way around. Just keep that in mind, so that which one should be added, which one should be deducted, will be easier to decide. Now, yes.
sorry to interrupt.
Yeah.
Just quick check. If expense is decreasing, it means few expense like things which has been given in the question, which can't be considered, is waived off. So
correct.
In that case, we have to still include it in a profit.
Yes, you're right.
Okay.
Absolutely right. Yeah. So coming to another concept of general deductions. So there will be a lot of expenses mentioned in the question. To be honest, I have not covered those specifically expense wise, because that way it will be too clumsy, too cumbersome for us to remember. which is why we will remember those by practicing questions. And it would actually make sense when we look at some expenditures which are being disallowed by income tax. For example, we had discussed, if you remember, the personal expenses. Personal travel of of the CEO or the owner, those are not business expenses, should not be allowed. Even if they have charged in the profit and loss account, it should be added back. It should be added back. Similarly, a capital expenditure. Capital expenditure, if you remember, I told, suppose an asset is being purchased. If the asset is being purchased, that should not be charged to profit and loss account, right? That is an asset that should not be charged to the profit and loss account. If the company has done that in their profit and loss account, it should be added back to the profit. Now, similarly, a very basic concept is, the business or profession. The expense, whatever we are charging, it should be related to the business or profession, as the case may be. One other concept I remember, which we discussed, was suppose there is an income which is related to another head. Suppose we have profit on sell of an land, profit on sell of an land, which is included in the credit side of the income statement. What should we do about it in deciding the profits or gains from business and profession? Should we add it? Should we deduct it? Those two are the options.
It will be like charged under different source of income, right? Other source.
Should it be deducted? Should it be added? Now,
It should be added to the profit.
no. While calculating the profit gains from business or profession, we'll have to deduct it. In the income statement, it would have been actually given in the credit side, meaning thereby it has already increased the profit. Now we will deduct it because it has to be charged on another head only altogether. Does it make sense?
Yeah.
Perfect. Now, another concept that we discussed very quickly about partnership firm. Partnership firm, there was a specific concept of interest to the partners, where we were calculating how do we calculate the allowable salary bonus, and also the interest is limited to 12%, but again, that depends on the partnership deed. If the partnership deed is saying 8%, it has to be 8%. If the partnership deed is saying 15%, it has to be 12%. Now, coming to salary, bonus, commission, remuneration, as the case may be, we had a comprehensive discussion on it, where we were calculating the book profit first. Let me remind you, book profit was what? Book profit is allowable profit. Allowable profit. So all the disallowable expenses are removed now. Only the allowable profit before only one item, that is the salary, bonus, commission, or remuneration, as the case may be, which is the discussion in case. Now, what I said was book profit is nothing but allowable profit before salary. That's all. Now, taking that book profit, we had one calculation for the first 3 lakhs of the book profit. It is 1,50,000 or 90%, whichever is higher. On the balance, it is 60%. Now, if our book profit is less than 3 lakhs, we will not go to the balance side. That is the 60% side. Make sense? So in this way, in 10 minutes, we have revised all the concepts of PGBP. Please do it your side. Easy to remember once you actually go through and revise like this again and again. Even better way to remember is to practice few questions. So we'll take up 2 questions right now from PGBP, then we'll move to capital gains. So I have little limited time right now, so I'll be there till probably 30 more minutes. So we'll see how much of capital gain we can start off with. We will see after completing these questions. Let's read out this question. We have X and company, a partnership firm, furnishes the following profit and loss account for previous year ending 31st March 2021. So cost of goods is given, other expenses is given, interest to partners is given, salaries to partners is given, sales is given, and there is a net loss, no profit. Here is the case of loss, 1,72,000. The other expenses debited includes 13,600 not allowable under section 31 subsection 1 of the act. Interest to partners is in excess by 7,100, not statutorily allowable. Compute book profits, admissible salary to partners, under section 40 subsection B, and income of the firm. Now, let me remind you, I had actually discussed this question. I had given the information needed. Let me give those once more. We have a net loss of 1,72,000. This has been reached after deducting salary, after deducting interest, after deducting other expenses, after deducting cost of goods sold. Now we'll obviously have to add back salaries here because we want the profit before salary. Now the other expenses, which is including 13,600, which is not allowable. If this is not allowable, and it is included in the other expense, should we add it now? Should we deduct it? Can somebody tell?
We have to add it because it's already deducted.
Absolutely correct. Now, interest to partners is in excess by 7,100. What should we do about this?
That also has to be deducted.
No.
Sorry, added.
Yes.
That should be added.
I got it. So now what you have to do is please calculate the book profits and tell me the book profits. Then we'll move forward to the salary side. I've already told what all things to be added. You just have to add that. That's all. Book profit / loss. Okay, we're just 3 of us now. It's okay. Many of us are actually waiting for the video. It was too early, I guess, after the exams.
So many of these people are still in college.
Yeah. Campus, no? I got it.
They were studying 83300.
83300 is the correct answer. So now that we have the book profit and 83300 is in negative, right? That is loss.
Loss. Yeah. Yeah.
So now let's apply the provision. Let's revise the provision first before we move forward. The provision was first 3 lakhs of the book profit. It is 1,50,000 or 90% of the book profit, whichever is higher. Second one was on the balance of book profit. It was 60%. Now it is definitely not more than 3 lakhs. So it is falling on the first category only. We don't have to go to the 60% side. Now in the first line, it is 1,50,000 or 90%, whichever is higher. Which one will be higher?
It will not be applicable because we are making losses, right?
Exactly. So our 1,50,000 will be higher in any case. So our allowable salary or commission is 1 lakh. Actual salary is how much? 68,000, right? So the whole 68,000 will be allowed. Make sense?
Yes.
So our final income, PGBP income would be 83,300 loss minus 68,000, would comes to 1,51,300 loss.
Booked income, and now this is income. Minus 83,300 minus 68. Only like 51,300. Yeah.
Yeah. Now this was a simple example on the partnership side. There will be a question on this. So other one is the what do you call it? The depreciation calculation. I have one question on that also. Let's look at it. The question reads: Venice Limited engaged in manufacture of pesticides, furnishes the following particulars relating to its manufacturing unit at Chennai for the year ending 31 March 2021. Opening WDV of the plant and machinery is given as 20 lakhs. Now, let me revise one concept before we read the next line. Our 180 days concept was if the asset is put to use less than 180 days, then half of the depreciation will be allowable. Now, that 180 days, if you calculate from the 31st March and backwards of a particular financial year, then it comes to the date of 3rd October. What does that mean? If an asset is purchased and put to use after 3rd October, that will be half of the depreciation level. If the asset is purchased and put to use before 3rd of October, it will be full depreciation. Simply, if we remember 3rd October, that would be easy for us to analyze and
So
put
Dheeraj, even if it is purchased on 3rd October, it will not be applicable, right?
it will not be applicable. You are right.
It
Yes.
should be either before of 3rd October
If
for
it is,
getting 10% or 20% depreciation.
if
No,
it
if it is
is,
on 3rd October, it is considered before, right?
No, no,
Because
3rd
we-
October, it may not be considered, right?
so look at this. Okay, March of a month is 31 days. Feb is supposed 28 days. Jan is our 31.
31.
December is 31. November is
30.
30. So if you do a total of it, it comes to 151. Now, what the provision says is, let me show you the provision once, where an asset has been acquired during the previous year and put to use for less than 180 days. So if it is less than 180 days, then only 50% happens. If it is 180 days, that is fine. Okay.
Yeah.
So what we are looking for is 180 days. If it comes to, then that's fine. So what I'll do is this, this is equal to 180 minus this, that comes to 29. 29 is what? 29 is our number of days more required to reach the 180. 180, that means that if we...
Second is the date when we should be taking.
Second is, so in the October month, where we have 31 days, where we have 31 days, if we deduct 29, that becomes 2. So on the 2nd of October, what we just learned is, till 2nd of October, if we purchase the asset, that is fine. Now let's bring in the concept of 180 days, what we considered less than 180 days, that thing. Now, when I did 180 days minus 151, that means I'm considering 180 day also, 180 also. But actually, in 180 day also, that is fine. Because what it is saying is less than 180 days. I should actually consider 179. I should actually consider 179.
Then it is 3rd.
That in that case, 3rd also is included. What does that mean now? Now, till 3rd of October, it is actually 180 days
80.
already. I mean, that 180 days concept is fulfilled. So 3rd of October is also included on the full depreciation side. That's what I'm trying to say.
Yeah.
After 3rd October only, the half of the depreciation comes into picture. 3rd of October actually won't be there in the question. That complication is not there for us, to be honest. So we don't have to worry much about it. Just because you brought into, went into that discussion, so I wanted to mention, if you got a little bit, for others, whoever is listening, if you got a little bit, got in doubt about this discussion, forget about it. Just remember the 3rd October, before it is full, after it is half, just that. So let's not complicate that anything anymore. Okay, now that we have discussed that, let's read the next line. New machinery purchased on 1st September 2020 is 10 lakhs. Is it full depreciation? Is it half depreciation?
Full depreciation.
Full depreciation, that is perfect. New car purchased on 1/12/2020, 8 lakhs. Full depreciation or half depreciation?
Half.
Half depreciation. Computer purchased on 3/1/2021, 4 lakhs. Full depreciation, half depreciation?
Half.
Half, right? So now that we have got clarity about that, let me just remind one more provision, which was about additional depreciation. Additional depreciation was applicable for all the newly purchased plant and machinery. Here we have 3 categories of new purchases. Here we have 3 categories of new purchases. But let me, before analyzing a little more about it, let me remind you about one provision which I forgot to revise today. What's this? Give me 1 second. Enhanced depreciation, when we discussed, this was another part I forgot to revise. Enhanced depreciation shall not be allowed in respect of plant and machinery used by any other person. So any used plant and machinery, enhanced depreciation or additional depreciation will not be allowed. Any plant and machinery installed in office residence, also the additional depreciation will not be allowed. Okay. Now that I have revised that concept, let me go back and read out the first additional information given in this question. It says all assets were put to use immediately. Computer has been installed in office. Which computer they're talking about? The last one.
Last line.
So tell me on which assets the additional depreciation will be allowable.
Only new machinery purchased.
Only new machinery purchased and car purchased also, right?
Car purchase.
Car is also a plant and machinery, so that is also fine. So now that we have discussed that, let's talk about the percentage. On the new machinery percentage, how much percentage of additional depreciation?
20%.
On the new car purchased, how much percentage of depreciation, additional depreciation?
10%.
10%. That's the trick there. So we have to remember the additional depreciation is also becoming half of it. So moving quickly to the next information, during the year ended 31/3/2020, new machinery had been purchased on 31/10/2019 for 10 lakhs. Additional depreciation besides normal depreciation had been claimed thereon. So what they're saying is during 31/3/2020, a new machinery had been purchased on this particular day, 31 October for 10 lakhs. Additional depreciation besides normal depreciation had been claimed thereon. Now, what this information means is it is referring to a previous year. It is referring to a previous year.
Yeah.
Now, in that previous year, we had purchased one plant and machinery for 10 lakhs. On which date? 31/10/2019. We must have claimed additional depreciation on it. But how much? Is it after 3rd October or before 3rd October? After, right?
After.
So we must have claimed only half of that as additional depreciation. So other half will be allowed in which year? This year. The whole logic is that only. So when we were discussing additional depreciation, what I mentioned was, if the additional depreciation is being allowed on a particular machinery which is put to use for less than 180 days, then the additional depreciation becomes 10%. However, the other 10% will be allowed in the next year. Now, here is a case where it is completely clearly mentioned in the previous assessment year, there was a purchase of new machinery on which we had claimed additional depreciation, but half only. So other half will be allowed this year. Make sense?
But Dheeraj, one question. The regular depreciation will not be allowed beyond
regular
half,
depreciation,
right?
Regular depreciation will be already be included in this part. When they say the opening WTB 20 lakhs, it includes this 10 also.
No, but the earlier, the question like when the car was purchased in 112, even the depreciation we are taking is only 50%, right?
Normal depreciation will also be 50%, but other 50 will not be allowed anymore.
Yeah, because out of 360 we have used only for less than 180 days.
Yes, yes. So that is what.
But that will, my point was that there is nothing to carry forward or other things in the regular depreciation.
In the regular depreciation, there is no carry forward. Yes.
Enhanced depreciation.
Yes, that is a major difference between normal depreciation and additional depreciation. You are absolutely right. Yes, something to remember. So very quickly, if we don't have, we only have 3 of us now. So okay, let me just do exactly what I just discussed. So 20 lakhs is the opening WDB on that 15%, which comes to 3 lakhs. 10 lakhs new plant and machinery. Again, if you remember, we had discussed no half needed because it is before 3rd October. So 10 lakhs also 15%, that comes to 3.5. Sorry, not 3.5. On that, additional depreciation of 20% will also be allowed. So total is 35%, that comes to 3.5 lakhs. New car purchase for 8 lakhs. It is after 3rd of October. So now it is half of 15%, which is 7.5% of 8 lakhs comes to 0.6 lakhs. So on the plant and machinery side, it is 7.1 lakhs. Please make a note of it. Computer is 40%. So that becomes a whole different block altogether. We cannot include it in the normal plant and machinery. A block has to be the same type of asset and also same rate. If it is not the same rate, it will be a separate block only. Even if computer is a plant and machinery, but still has a rate of depreciation of 40%. That's why we will have a separate block for it. Now, in that block, 4 lakhs into 20%, that comes to 20% because it is after 3rd of October. So half of the rate. Rate normally is 40%. If I'm not wrong, 40 only, 40 or 30?
Yes, computer is 40.
40, yes, computer is 40. So 20%, that comes to 0.8. The only thing that I have missed out here is the additional depreciation on the remaining plant and machinery. That is 10 lakhs into
10%.
10%, you are right. 10 lakhs into 10%. That comes to 1 lakh only. So I'll add here plus 1 lakh. That becomes 8.1 and this side is 0.8. Our total depreciation comes to 8.1 plus 0.8. So 8.9. No questions, right, on this?
Yeah.
Pretty much clear. So there will be again question from depreciation for sure. Be it 6 marks or it can also be a 10 marks question. Anything can be there. So that is about PGBP. Please revise the provisions whenever you have time. There are so many things to remember, but it is not exactly same as how we had in salary. So here the only way to remember will be to practice few questions. More questions you practice, the more you remember how to calculate those stuff. Okay, let me come back to capital gain, not spend much time over it because we are very less people right now. But and also I want to wrap it up in 15 more minutes. Okay, capital gain when we discuss, let's talk about a simple concept of when does capital gain come into picture. Now, capital gain is you know in our discussion or in one's income tax return only when he has sold some asset. He has sold some asset. Now that asset can be a short-term asset, that asset can be a long-term asset. Now there are some specific calculations with relation to short-term and long-term. We will discuss that when we are in that discussion. But the only thing to focus on is the primary part is it should be an asset. The sale of an asset must have been there to draw this charge of capital gain. Now, very simple example. If I say, suppose I have sold one asset for 120 rupees. I had purchased for 100 rupees. How much of profit have I made? 20, right? Very simple example. So how much of capital gain should be charged? 20 only, right? Yes. You can hear me, right?
Yeah, we can hear you.
Okay. Now, a simple example: if we have sold an asset for 120 rupees, we had purchased that asset for 100 rupees. Our profit becomes 20 rupees. That is what we are going to do in this whole discussion. Just that there are some specific other scenarios that are being covered by some special provisions. There are some specific exemptions available that we will discuss going forward specifically. Now that we have had the generic conversation, let me stop here and ask you in case you have any doubts or any questions on that. No? Yes?
Look, Dheeraj, here when we say capital gain,
yeah,
this will include your asset capital also, right? Not only the share capital.
Asset also, if you have invested some shares in some other companies, that is also included here. Any type of asset.
No, I'm saying like when we have a house, we studied during our salary thing, right? If you sell the house, something capital gains have to be included.
Correct.
So that also will be applicable here, right? Or it's only shares?
No, that also is applicable. Okay. House, car, land, building, that's all included. So yes. Now let's very quickly move to the short-term and long-term aspects of it. Normally what happens is in accounting terms, we had the logic of 12 months, 1 year. If the economic benefit from one asset is received in more than 1 year, that was called long-term asset. If it is less than 1 year, that was short-term asset. However, as you have realized in income tax, it is completely different. Most of the things here, there are actually multiple categories. There is 12 months, there is 24 months, there is 36 months, but we will remember only two, which is this. For listed shares, that is stocks that we purchase, from stock market or from IPO, for them it is 12 months. For all other assets, 36 months. Only remember this, forget about everything else. 36 months, so 3 years. So what they're saying is, If you have hold one asset for more than 36 months, that is more than 3 years, then only we will consider it as long-term asset. If it is less than 36 months, we will consider it as short-term asset. What is the difference between short-term and long-term? The rates are different. The exemptions are different. The calculations are different. I'll just show you what are the major differences between a short-term and long-term just in a bit. But the whole thing is different between a short-term and long-term. So what I said was, for the listed shares or the stocks, it is 12 months. Please note down, please make a note of it. I'm saying listed shares. There are shares of company which are not listed. Can you give an example of when the shares are not listed?
Startups generally.
Exactly. Any private company for that.
IPO. Yeah,
any private company. When a company does not go public, its shares are not listed. When do we call a share to be listed? When it is listed with SEBI, Securities Exchange Board of India. When it is a private company, the shares are just with the company. It is not in control of the SEBI. It is not with public. So it is called unlisted shares. So unlisted shares, it is still the other category. However, there is some, yeah.
So only these two type of assets is going to contribute to capital gain, or we have anything else also apart from this listed and unlisted asset?
We have so many. You talk about any asset. You talk about car, you talk about machinery, you talk about land, building, any asset for that. Everything is falling under 36-month category. Okay. Makes sense, right?
Yeah.
Yeah. So when I get
if our car can't be in under 12 months category, right? It can be only in 36.
36 months on. Yes, 36 months.
36.
Yeah. Okay. Yeah. So okay. Now that we have discussed that, okay, that unlisted shares example I was giving, that is actually falling under another category. So let me just bring back that discussion and not discuss it at all. I don't want to confuse things. I just want you to remember 36 and 12. Forget about the unlisted shares. Okay. Let's talk about short-term and long-term a little bit more. In the short term, actually, the capital gain tax rate is 15%, where the long-term tax rate is 20%. Short-term rate is 15% and long-term rate is 20%. Now, in the short term and long term, in both the cases, the structure of calculation is mostly same, except just one difference. I'll show you. In the calculation of short term, if you notice, we take the sell value, that is 120 in our small example. We deduct any expenses on transfer. What are the expenses on transfer? When you sell one property, you have to have a sell deed, you have to pay some notary fees, you may have to pay some stamp duties. Those are expenses on sale. Or suppose, other types of very generic sales will be, you have gone to meet your purchase buyer, and you have invited him to a restaurant, you have arranged some meal and you are eating together. Those expenses are in relation to the sell only. So those are also expenses on transfer. So those are just examples, no need to remember. So what I'm trying to say is, those expenses on transfer should also be deducted from the sell value. Those are deducted. Then we deduct cost of acquisition, which was 100 in our example. Whatever you get, that is your gross short-term capital gain. Now, from that, you deduct the exemptions. We have not discussed the exemptions yet. We will have a separate discussion maybe today evening if we get time. Then you get the final taxable short-term capital gain. You don't have to remember the calculation. We'll practice questions. Through that, we will remember very clearly. No problem. You don't have to by heart this part. Now, only difference between this and the long term is, in place of cost of acquisition, there is a separate word called indexed cost of acquisition mentioned. What is it? Indexed cost of acquisition. What does this mean? It means, suppose you had purchased one asset on 2012. Suppose you purchased one asset on 2012 for suppose 1 lakh. You sold the asset on 2021 for suppose 15 lakhs. Now tell me, what is the profit you made?
14
14 lakhs, right? Now here the income tax department can come and say, you know what, you have to pay us tax on 14 lakhs. That comes to somewhere around, if we multiply 20%, that comes to 2,82,000. 2,82,000. Just look at the facility or the benefits given by the income tax department. They say, you know what, no. You had purchased on 2012. You have sold on 2021. That cost is not same as 1 lakh on 2021. We will give you the benefits of the cost on 2021. How do we calculate the cost on 2021? They have given some standards which are called CII, cost inflation index. You must be remembering, we had discussed in the class. These are the CIIs. Based on these, we can calculate if the value was 2012 1 lakh, what will be the value on 2021? If you look at this, 2021, the rate is 317, and we had 12, which was 2012, I saw, right? 2012, the rate was 200 only. Yes, 200 and 317. Now that
so we look at assessment year or we look at financial year?
I'm not going that detail. Shall give me some time.
No, here, because if you say 11-12 is 187, 167, and 13, so that's the number we have to take, right? 12-13 or 11-12? So
what I have mentioned is not the exact date, right? Depends on the exact date, right? Now,
no, so suppose I